I'm going to introduce our speaker, but before I do that, I wanted to tell you that we had this great conference last year. Many of you were there. It was a conference in honor of John Taylor. The book's out, and this is the book. Okay, it's a fantastic book. Yeah, it's your book, John. So I thought everybody should get a copy of this. Okay, they did a spectacular job. And now I'm going to just, you got a copy of the book, eh, John? You did. Okay, he did. Okay, so I'm going to introduce Tyler Goodspeed, and I've known Tyler quite a while. I guess since I've been coming to Hoover, and he's going to be our dinner speaker. Tyler has worn several hats in his young career. He was a Hoover Junior Fellow. That's how I met him. He was a professor in England. He's a policymaker. He was chair of the U.S. Council of Economic Advisors in the last Trump administration, and now he's a chief economist in the corporate world. Now, and he's an economic historian. That's the most important thing. And as an economic historian, he authored an excellent book on free banking. This is like maybe 10 years ago, and I think we had him come to my university and talk about it. But now he's going to tell us about his new book, very superb new book on recession. This book, which everyone interested in, in salient economic issues should read, it's really unique. It combines historical narrative and data for several centuries, covering every business cycle in the UK and the United States. And the purpose of the book is to answer the question, what causes recessions? And I'm not going to go through it's his book, he'll tell you about it. But one thing I'll say, his analysis shoots down just about every well-known explanation, including something I once did with Joe Halbrick, who's here, and ends with these fascinating insights of his own. So I'll let him tell you about his story. So thank you very much.
Thank you, Mike. I must say it is a real pleasure and privilege to be back at the Hoover Institution. Looking around, I see many friends and former colleagues. And I should note, I see many friends who are also former colleagues. I see no former colleagues who are not also friends. I must underscore up front that my remarks this evening represent my own views and should not in any way be interpreted as representing the views of any other individual or entity. If asked when the price of a barrel of oil reached its all-time high, one might reasonably offer 1973 during the Arab oil embargo. 1979 following the Iranian Revolution would be another good guess, as would 1990 during the Iraqi invasion of Kuwait. But the correct answer would be June 2008. In fact, since 1945, the inflation-adjusted cost of energy was never higher than it was in summer 2008. As a result of a confluence of unanticipated shocks to both energy supply and energy demand, by the summer of 2008, the average American household in 2026 dollars was paying $8,500 per year on energy goods and services. That was $2,000 more than they'd been paying just a few years prior. In 2026 dollars, the price of a gallon of gasoline reached $6.17, the highest ever to date. As high energy costs drove up the cost of fertilizer and farmers shifted production toward the production of ethanol from corn, in part in response to new policies, food inflation spiked to above 6%. For many American households, remember, half of whom typically have no savings after tax, it was unsustainable. Driving to work, dropping your kids off at school, heating and cooling your home, putting food on the table, these are not exactly expenditures on which it is easy to economize. Under financial pressure, by summer 2008, about 5% of American homeowners had thus fallen seriously behind on their mortgage interest payments. And the rest, as they say, is history. Like tropical storms, we tend to name recessions. But unlike the naming convention for hurricanes, for storms of the economic variety, we have this persistent habit of naming them after some ex post perceived excess during the preceding economic expansion. Hence, the 2008 recession was not the 2008 energy crisis, it was the housing bubble. The relatively mild and short recession that inaugurated the 21st century was not the 9/11 recession, it was the dot-com recession, the dot-com bubble. Earlier this year, many economic commentators were already writing the obituary of the current economic expansion at the hands of an anticipated AI bubble. But is it true that to understand episodes of economic contraction, it is first and foremost to the contours of the preceding economic expansions to which we must turn? Do expansions die of their own cumulative excesses, imbalances, fragilities, their advanced age, their infirmity? Or, in the words of Ben Bernanke, are they murdered? The notion that expansions are ultimately culpable for their own recessionary death is certainly one of august provenance. The MIT economist Charles Kindleberger's classic, Manias, Panics, and Crashes, is currently in its 8th edition. And though you may protest otherwise, most of you still believe it. That's why we call the 2000 recession the dot-com recession, the 2008 recession, the subprime crisis. There's British economists among us. Many British economists still assign blame for the 1973 UK recession on the so-called barber boom. Now, fortunately, the boom-bust view of economic fluctuations, the manias, panics, and crashes view, is scientific in one crucial sense. It yields empirically testable, falsifiable hypotheses. Unfortunately, inference is fraught insofar as one relies exclusively on the 12 US recessions since 1945. Because though one may think that with quarterly or monthly data available since 1945, one has all these degrees of freedom, the reality is you have 12. With a slope and an intercept, you've just chewed through 2. So in the book, I extend recession chronologies and multiple macroeconomic time series all the way back to 1700 on a consistent basis in the United Kingdom and the United States to examine no fewer than 6 key hypotheses generated by the boom-bust view of economic fluctuations using a sample of 132 recessions. First hypothesis: if recessions are fundamentally a function of human psychology or processes that inhere in economic expansion, then we should expect to observe that the frequency of recessions is roughly constant across time and space. But over the past 200 years, the United States was vastly more recession-prone than the United Kingdom, by a factor of 2. In just the past century, The United Kingdom avoided recession in 1937, 1948, 53, 57, 60, 70, 81, 2001. US recessions each. And recessions on both sides of the Atlantic have become much less frequent over the past 3.5 centuries. And that is a long-run structural trend dating back to 1700, and a Chow test cannot find a statistically significant breakpoint at any specific points in time, with the possible exception of 1785 in the United States. And you can just think about some recent institutional changes then. Second, variation in the height, the speed, or duration of economic expansions should explain something of the variation in the depth, the speed, the duration of the succeeding economic recessions. Deeper, faster, longer recessions should succeed higher, faster, longer expansions. They do not. Not for GDP, not for consumption, not for investment, not for bank credit. Estimated coefficients are 0. Third, expansions should die of old age. If recessions are the consequence of cumulative excesses, imbalances, or fragilities that build up during the preceding expansion, then we should expect that the probability of expansion death should increase with age. But it does not, and contrary to the seminal work of Diebold and Rudbush, I find that expansions on both sides of the Atlantic have never died of old age. They have always been Peter Pan rather than the picture of Dorian Gray. Fourth, more broadly, there should be some information in an economic expansion that can inform the probability of the subsequent recession. But the yield curve, the SOM indicator, credit spreads, cyclically adjusted price to earnings ratio, leading economic indicators, dynamic factor models with Markov switching, skyscraper indices, all of them abound in false positives and false negatives over the past 4 centuries. Recessions are fundamentally unforecastable. I mentioned the 2001 recession, conventionally attributed to a peak and subsequent decline in US equity valuations. Incidentally, tech stocks had already started to recover by the start of that recession. But that was just one of at least 4 shocks impacting the US economy in 2001, not the UK economy, incidentally, but the US economy. And I demonstrated in the book that quantitatively, it was the least important of those 4 shocks. And we have estimates of the responsiveness of consumer spending to changes in financial wealth, and they cannot explain the magnitude of the decline in consumer spending in the 3rd quarter of 2001, especially if one considers that tech stock ownership was skewed heavily toward high net worth and high income individuals who tend to be less responsive to changes in financial wealth. The most important of the 4 shocks in 2001 were the terrorist attacks of September 11th. And in fact, all of the output decline during that relatively short recession occurred during the 3 months that included those attacks, the consequent closure of US airspace, widespread fear among consumers, households, and businesses, and economic activity grinding to a halt in the economic center of what was then the 2nd largest economy in the United States. And that was unforecastable. Fifth, the rise of a more interventionist, counter-cyclical state should have attenuated the depth and duration of recessions over time. Yet on both sides of the Atlantic, statistically, recession depth and duration have been constant over time, going back to 1700. If anything, UK expansions have been longer since 1945 rather than shorter. And recessions have always died of old age. The strong age dependence of recessions is not a modern phenomenon. Within cycle macroeconomic volatility has declined since 1945, but it's actually only declined to levels that prevailed before the incredibly martial period between 1914 and 1945. Finally, sixth, if recessions are performing some cleansing, reallocative, corrective function, then several years on from a recession, we should expect economies to look fundamentally different from how they would have looked had they continued uninterrupted along long-run trends. But several years on from a recession, using a HP filter or Hamilton filter, the allocation of people, capital, and output typically looks remarkably similar to how it would have looked had the economy continued uninterrupted along long-run trends. And far from enhancing the reallocation of people and capital from less to more efficient firms and enterprises, recessions are rampant age discriminators. They discriminate against younger workers. They discriminate against younger, more dynamic firms. They discriminate against research and development. They impair rather than enhance the process of creative destruction. In his classic novel, Leo Tolstoy opened with the line that all happy families are alike. Each unhappy family is unhappy in its own way. Recessions, I contend, are apt illustrations of what I describe as the Anna Karenina principle. While ongoing economic expansions are broadly similar, there was mention of Mariana and Bob Hall's work earlier today, gradual yet inexorable recoveries from earlier contractions that lead to positive trend economic growth over the long term. Every recession instead represents an economic expansion that failed or was terminated in its own way. Indeed, as early as 1927, it was actually, ironically, a Soviet economist in Moscow, Eugen Slutsky, better known for the Slutsky equation, but Eugen Slutsky, who demonstrated that the summation of random or chance causes could generate what looks like cyclical behavior, cyclical fluctuations, even though the underlying data generating process is random. And if we could move to the next slide, Slutsky used old Russian lottery ticket numbers to construct a moving sum, and the resulting series mapped perfectly, or almost perfectly, onto an index of British business conditions over nearly half a century. The problem is that this idiosyncratic nature of recessions, it rebels against our evolved human logic. We are pattern-seeking mammals. Patterns are how we relate observed stimuli to subsequent negative experiences. The ingestion of colorful mushrooms followed by illness, the excess exposure to sunlight followed by sunburn. So too with the negative experience, even trauma, of recessions, do we thus seek to relate that trauma causally to some precipitate action or actions that we might endeavor to correct in the future, lest we incur that trauma and guilt again. Yet our search for patterns, such as predictions of recessions or predictive models, can often lead us to connect data and events that appear related, but are in fact random or unrelated. It's actually a common effect of our cognitive wiring, the technical term for which is apophenia, the opposite of an epiphany. And the stories we tell ourselves about recessions abound in epiphanies as we seek patterns in the height, the speed, the duration, the constitution of an economic expansion that can hopefully explain the likelihood, depth, speed, duration, and composition of subsequent recessions, and, crucially, impart a moral lesson. There's a reason parables are among the most enduring stories for humans. But a key lesson of the long history of recessions is that statistically, there is no information whatsoever in the contours of an economic expansion that can explain variation in the likelihood or contours of the recession that follows. And so our apophonous thinking about recessions isn't innocuous, because it can lead us to attempt to sedate or otherwise medicate economic expansions that fundamentally die healthy in the mistaken belief that doing so can prevent recessionary death. Great historical events, like deep recessions, do not require structural causes or inevitable deep historical forces. The reality is typically more prosaic. Consider again what began as the 2008 energy recession. There is a counterfactual state of the world, and not an improbable one, in which that was your typical garden variety post-1945 energy-related recession. But what turned that into a much deeper contraction was, ironically, a British commission of a very American error. The classic, even textbook, British response in moments of financial stress, going all the way back to 1826, as the economic historians in the room will know, often fueled by ham sandwiches and whiskey over late nights and exhausting weekends, was to adhere to some form of Bagehot's rule, in concert with the Bank of England coordinating and facilitating the acquisition of weaker banks by stronger banks. Indeed, this was precisely what allowed the United Kingdom to avoid recession in 1866, in 1873, in 1890, and to avoid what could have been a much deeper recession during the oil embargo recession of 1973. But in September 2008, over the pivotal weekend, the Chancellor of the Exchequer blinked and instead adopted a classic American approach, which was to permit institutional barriers to block the timely acquisition of a weaker bank, Lehman, by a stronger bank, stronger, healthier bank, the very well-run, well-capitalized Barclays, before then immediately proceeding to publicly bail out other financial institutions in the disorderly aftermath. And we know the consequence. Reserve Primary Fund broke the buck because of its nearly billion-dollar investment in Lehman commercial paper. As Lehman US conducted a global cash sweep at the end of every trading day, when the US parent filed for Chapter 11 bankruptcy protection, Lehman International in London immediately had to file for protection under an administration order in London. This effectively froze all of Lehman International's assets and liabilities, including the collateral of institutional clients whose funds they had rehypothecated, triggering a run on UK financial institutions by institutional investors. So while recessions are inevitable, there has never been an immortal economic expansion. Any given recession in any given year is not. They are conditional. They are historically contingent. But though we may be unable to predict recession, the evidence is unambiguous that expansions have been living longer as we, households, businesses, learn how to better absorb the kinds of shocks and the magnitudes of those shocks that historically would have generated recession. Moreover, while we worry a lot about recessions, and rightly so, because recessions hurt a lot of people, we ought to be at least as concerned about economic expansions. The United Kingdom, as I noted, was historically much less recession-prone than the United States. The United Kingdom is also, and has long been, at least 30% poorer than the United States. Ultimately, the majority of years in which economies expand matter much more for long-term economic prosperity and indeed human flourishing than do the minority of years in which they contract. And though it may be odd for remarks about recessions to so conclude, so it does. Thank you.
I think we have time for a couple of questions, right?
Very nice, really thrilling presentation. So why should the baseline be that these things would be predictable? If you thought they were predictable, you could make money on them. And so the theorem would be they're not going to be predictable. So especially as expectations have come to revolutionize macroeconomic thinking, and Kindleberger might have been a little too early for that. But, I think Samuelson wrote in the 60s, you wouldn't expect predictability here because of the role of expectations. So what do you think about that? So really you're saying that confirmation of the theorem, I guess.
So this was posed to me by a very eminent macroeconomist recently who referenced the Queen posing the question in 2009, why did no one see this coming? And the after-the-fact answer of the macroeconomist was, well, because these things are unpredictable. If we knew that there was going to be a bank run tomorrow, we would pull our funds today. If we knew that there was going to be a recession tomorrow, then we would save more today, invest less today, hire less today, and we'd have the recession today rather than tomorrow. So we can simulate these shocks, we can estimate the impulse response functions, but we can't predict them. To which I then asked him, well, what do you call the 2001 recession? What do you call the 2008 recession? And he said, it was the housing crisis. It was the dot-com bubble. It was the housing crisis. So what implicit in that is that there is some information, that cyclically adjusted price earnings ratio, housing prices, that there's some information in that expansion that should or could have predicted the subsequent recession. And yep. But that's sort of, because I would say the main message is that we probably ought to be taking our models and that prior more seriously, because after the fact, we always fall into storytelling mode. And I think that is a key insight of Schiller's.
Yeah. Anybody else?
Steve.
Oh, Steve.
So a comment in a way in thinking about what you're describing. You can think of recessions as falling Poisson processes. And each instance of the Poisson arrival process might be unpredictable. Nonetheless, we might undertake some reforms over time that reduce the Poisson arrival rate. And it seems to me there's one clear example of that, not so apparent in the history of the United States and the United Kingdom, but if you look at a broader set of countries around the world, there's a pretty clear pattern that civil wars, or large-scale civil wars, are pretty much almost guaranteed to trigger a recession, if not a depression, in that country. So whatever we can do over time, and at least if you believe Steven Pinker, and perhaps until quite recently, there has been a long-term secular decline in various indicators of violence, including interstate conflict. So I do think that, and it's not inconsistent with anything you said. It rather shifts the focus towards, yes, there are many potential culprits of the murder that is a recession, but we can take some of the worst culprits off the table or make them less likely to occur, and thereby reduce the frequency of what is still essentially an unpredictable event.
So one of the things, Steve, I like about your question is that you largely answered it. So I have two key thoughts because I think this is essential, and it speaks to unconditional probabilities in any given year. So, for example, over the past century, the unconditional probability of a pandemic-related recession is about 1 in 100. The probability of a war-related recession has gone down, and in fact, one of the most prolific murderers of economic expansions in the 18th and 19th centuries, particularly the 18th century, on both sides of the Atlantic, was not just war, but war that really visited your soil, or World War. All of the longest recessions on both sides of the Atlantic have been war-related, with the one exception of the Great Depression. But there's a lot else going on with that. But all of them, the longest for the United Kingdom, it was the 1760s during the 7 Years' War. It was during and in the immediate aftermath of World War I, during and in the immediate aftermath of World War II. In the United States, there were colonial-related, war-related recessions. I also think so that has been declining over time. I also think the contrast in recessionary experience between the United Kingdom and the United States reveals two additional. So there are two main reasons that the United Kingdom was historically less recession prone than the United States. One was that from 1826 on, it had a nationwide system of branch banking. So you had a broadly diversified portfolio as your national banking system. The second was that from 1926 to 1972, the United Kingdom went without an official coal strike. And during that time, the UK economy was overwhelmingly reliant on coal rather than oil. When the United States went through from 1948, 53, 57, 70, all of which were oil-related recessions. So that diversification that has been going on over time in our banking systems and our energy systems speak, I think, to those processes you're talking about.
I guess take another question. Torsten.
Yeah.
Great.
So thanks so much. Yeah, this was indeed very fascinating. Thank you very much. I look much forward to reading your book. So taking the parallel to 2008, today we have a data center build out. A lot of people are worried about exactly the same. We had a housing build out. And that will, of course, ultimately, by definition, result in a slowdown in data center build up and therefore some slowdown, at least in construction growth of data centers. We might not be quite there yet, but at least the parallels to the Kindleberger view of building something up and then slowing it down is clearly there. And now, by coincidence, we also have an energy shock exactly on top of that, just like we had in 2008. So are we saying that the confluence of factors of some buildup, even if we think in your view that this might not be the source of a recession, but the combination of that with an energy shock, is that saying that there might be a recession coming later this year? Or are we still saying that it's just completely unpredictable?
Well, to the second question, having just written a book, a conclusion of which is that recessions are fundamentally unforecastable, I shouldn't be getting into the business this evening. To the first question, one of the things that really surprised me in the book is that when you look back on past transformational technologies, be it canals, be it railroads, be it fiber optic cables in the 90s and 2000s, the real physical infrastructure is remarkably faithful to long-run trends. And those trends resemble a beautifully smooth S-curve, adoption curve. And so heading into 2026, as everyone was worried about an AI bubble causing recession, my baseline on the basis of 3.5 centuries of economic history was that AI investments were more likely in the near term to be a casualty of a recessionary shock elsewhere than a cause thereof. And speaking of unconditional probabilities, I mentioned pandemics. If you look over the past century, in any given year, the unconditional probability of an energy-related recession in the United States, not the United Kingdom, but in the United States, it was 1 in 10. That has been declining over time, but that's the sort of century unconditional probability. But before the oil shocks of the post-war period that we're most familiar with, industrial action in coal was a perennial contributor to recessions in the late 19th and early 20th centuries. And before that, it was peat and provender. Peat being combusted for residential heating and industrial power generation, provender being the primary fuel for the primary source of ground transportation, namely animal draft power.
Thank you. Well, that was fantastic. Thank you very much.